Well, this is great to see you, and great that this is one conference we're having that we haven't had a blizzard or something else going on that seems to be a somewhat regular occurrence. But we have just mere rain today, and delighted to see everyone here at this is the 24th time we have gathered for these conferences. And I want to do a couple of things. First, introduce myself. I'm Janice Gregory, and I am the current president of the National Academy of Social Insurance, and very happy to be doing that for a while longer until my term is up. I want to praise and honor our three co-chairs, and I want to give you a little bit of an opening and take care of some housekeeping things, and then we'll get things officially underway. This is an extraordinary time for social insurance programs, in case you haven't noticed. There's two things in the news every single day. One is another Republican debate, and the other thing is a story about social insurance. Social insurance has captured the attention of the media, and it's become a target issue on all sides of the political spectrum. Preoccupation with deficit reduction adds a sharp-edged dynamic to an already impassioned debate over the future of social insurance programs. And it's in part because of the status of the programs themselves. We know that while it is basically sound, we will have to make some changes to Social Security at some point. Many would like to see it reduced. This is at the same time that many are finding how much they need Social Security because their private savings has been decimated. Medicare is changing in front of our eyes, both because of the Affordable Care Act and because of the simple problem we have with the cost of health, providing cost-effective value health care in this country. Unemployment, clearly a program that has long needed review and yet still a lifeline in the middle of the worst recession in our life, in certainly the lifetime of many in this room. And disability and workers' comp are also just there off the horizon and coming to the floor. So during this politically charged time, the Academy remains a place where various views and unparalleled expertise come together. And that's what we hope to be about over the next 2 days. Let me do a little bit of housekeeping, and then I will get things underway. First, I want to report that we're happy to have 250 people signed up, and they're coming from all across the country. We have many Academy members, and I want to single out 6. These are recipients of our conference scholarships. This year we received an unprecedented number of scholarship applications from young men and women in 21 states to come to this conference, and we had a hard time choosing 6. As I call your name, I'd ask you to stand and be recognized, although let's hold our applause till I list everybody. From Boston, Massachusetts, a candidate for Master's in Public Health from Boston University School of Public Health, Lucy Cox Chapman. Are you here? From Panama, by way of the New School for Social Research in New York City, where he's a PhD student in economics, Elroy Fisher. From Ann Arbor, Michigan, where she's a second-year student at the University of Michigan's Law School, Elizabeth Lamaste. From Helena, Montana, where she is a workers' compensation research analyst at the Montana's Department of Labor and Industry, Christine Shields. From Athens, Georgia, where he is a Master of Science candidate in financial planning at the University of Georgia, Justin Cole Smith. And from Santa Fe, New Mexico, by way of Cambridge, Massachusetts, where he is a student at Harvard, Alex Worth. Let's applaud our scholarship people. And keep an eye out for them as you're going around and talking to people. I would like to thank also the major sponsors of this conference, AARP, WellPoint, and the California Healthcare Foundation, as well as all the other sponsors of the conference who are advertised on the sign out front and in your packet. A few housekeeping items. If you'll check your folders, you'll find a welcoming letter from the co-chairs and complete details for today, this evening, and tomorrow. A warning, keep your name badges. There won't be new ones tomorrow, so you need to remember to bring your name badge back. We have the exhibit lounge, which is right next door, and all refreshments will be in there. If you use Twitter, you can join the conversation using the what do you call it, a hashtag? You can tell by my white hair I'm not a big Twitter person yet. It's NASI 2011. Huh? Did I do that right? 2012 now? NASI 2012. Good. I'm glad we're keeping up with the times. Some of us. In your packet, somewhere, I think it's on the back side of the left-hand side of the packet, there's a blue thing, and it's an evaluation. Please fill these out. We read them. I read them. We actually pay attention. We try to give you a conference that you want. If you have any questions, you'll see NASI staff around, and just ask them. We hope this will be rewarding to you. And now I want to introduce three priceless assets of the National Academy, our three co-chairs. Sheila Burke, who from the JFK Kennedy School of Government and the Malcolm Weiner Center for Social Policy, where she teaches. She also works at the Baker, Donaldson, Behrman, Caldwell, and Berkowitz law firm. Sheila's been a recognized leader in Medicare, Medicaid, and long-term policy for quite a while. Amazing, given her youth. And we are committed to, and she's committed to ensuring that the healthcare agenda remains a topic of discussion and debate. I first knew Sheila back when she was in the Senate, and I was over in the House. And she distinguished herself there in several jobs and was also a founding member of the National Academy of Social Insurance and recognized as the distinguished honoree for health policy at our anniversary celebration last June. Margaret Sims is a fellow at the Urban Institute and director of the Institute's Low Income Working Families Project. It's a research initiative exploring challenges faced by 9 million families and their 19 million children, a really tragic number. She has a long and distinguished academic career, which is outlined in your packet. And she has been a member of the National Academy of Social Insurance since 1994 and with my distinguished predecessor in the post that I now hold. Finally, James Roosevelt, Jr., President and CEO of Tufts Health Plan and the Tufts Healthcare Institute in Watertown, Massachusetts. He's also a clinical instructor at Tufts University School of Medicine. He served in the administrations both of Barack Obama and Bill Clinton, and he's one of our newer members. He became a member of the Academy in 2010. I don't know how we left you out there for so long, but we are so delighted that you are here with us now. And what we'd like to do is turn the podium over to Jim, and he will introduce our speaker, and we shall begin. Thank you.
Well, good morning, everyone, and it's great to see such a strong turnout this year. The theme of this year's conference, Social Insurance in a Market Economy, Obstacles and Opportunities, could not be more timely. As Janice pointed out, this is not the 19th Republican debate. That will be this evening after our dinner speaker on CNN. But we will be dealing with, I think, in, I hope, a more thoughtful way, some of the very same issues that will be debated both there and when we get to the general election, some of the issues that we heard raised by President Obama in his State of the Union message earlier this week. It's my privilege to introduce our opening keynote speaker, Professor Jeffrey Liebman. I've had the privilege of knowing Jeff for a number of years. As you see from his biography, which is in your packets, he is the Malcolm Weiner Professor of Public Policy at Harvard's Kennedy School of Government, and he focuses on tax and budget policy as they relate to social insurance, poverty, and income inequality. He's held a number of positions here in Washington. I had the privilege of working with him when he coordinated the Social Security Reform Working Group in the Clinton administration, and I was serving as Associate Commissioner of Social Security for Retirement Policy. But he is living proof of the positive aspects of human evolution. He comes from a family of lawyers. Indeed, his mother and his father, and I believe his brother, are all law professors. His mother was actually a mentor of mine when I was a very young lawyer, when I was a third-year law student in working at a legal services office. And he, on the other hand, is a PhD in economics. So without further ado, I give you our keynote speaker, Jeff Liebman.
Thank you, Jim, for that kind introduction. I usually don't admit this, but when I claim to have rebelled by becoming an economist, the truth is that my father, although he was a law professor, did a lot of writing on disability insurance, and so I didn't actually get very far away from the tree there. I'm honored to be here speaking to you about the role of social insurance in a market economy. I'm particularly honored to see so many people in the audience here today who've taught me so much about social insurance, both in my scholarly and in my public service roles. We're at a moment in our nation's history when our social insurance programs are both more important and more successful than ever. With the baby boomers retiring and more Americans living to older and older ages, ages at which the risk of outliving their retirement resources greater and greater, Social Security's old age and survivors insurance program is more important for more people than it's ever been before. And with income growth and technical advances in healthcare, causing Americans to want to spend a bigger fraction of their incomes on health care, the importance of programs like Medicare and Medicaid, which protect individuals financially when they have expensive medical bills and which also enable them to get the care they need, the importance of these programs has never been greater. And with American workers buffeted both by long-term economic trends and by the effects of the 2007-2009 recession, the importance of programs that protect Americans against the loss of jobs or the inability to work has similarly never been more critical. These programs include unemployment insurance and disability insurance. They also include the Supplemental Nutritional Assistance Program, SNAP, formerly called food stamps. You know, some people, when they try to define social insurance, exclude means-tested programs from the social insurance family. But that makes no sense. Means-tested programs provide insurance against loss of jobs or the loss of income in just the same way that a social insurance program like unemployment insurance does. And over the past few years, the success of SNAP, the responsiveness of SNAP in helping families who've fallen into poverty because they've lost their jobs in this recession or they've had their hours reduced or because they've had their wages reduced, the success of SNAP has been truly remarkable. Indeed, it's quite literally the case that it's our social insurance programs that saved our economy in 2009. If you look at the national income and product account data for the middle of 2009, what you see is that private sector incomes were still plunging in the second and third quarter there. But total national income and the total economy stabilized. And what happened was that income, primarily from social insurance programs, made up the difference. And that happened both automatically because of the way in which our social insurance programs respond immediately and automatically to need without any action by our government, but also because some of our social insurance programs were expanded through the Recovery Act. And it's, in fact, those provisions of the Recovery Act that were both the fastest acting and the biggest stimulus bang for the buck provisions in that act. As our economy recovers, our social insurance programs are playing another important function. Re-entering the labor force to take a new job or to start a new business can be risky. Sometimes things work out, sometimes they don't. But because of our social insurance programs, Americans know that if things don't work out, all is not lost, that they'll still have a backstop of income and of health insurance to take care of them. So in this way, our system of social insurance is essential to the risk-taking in entrepreneurship that makes for a vibrant economy. Our social insurance programs are also functioning better than they ever have. The use of information technology is reducing administrative costs and recipient burden in many ways, while also permitting programs to be more innovative. In Social Security, technology is allowing retirees to apply online for benefits and making it easier for SSA examiners to review medical evidence and disability claims. Medicare is innovating with new payment mechanisms, such as shared savings and accountable care organization models, mechanisms that will reduce expenditures and improve healthcare quality. States are using information technology to verify incomes automatically and to automatically re-enroll Medicaid families, reducing the inefficient cycling on and off of the program. SNAP eligibility rules have been simplified, and SNAP's error rates are at an all-time low. And the Massachusetts model that expands health insurance coverage using private insurers is about to be replicated all over the country. So let me repeat what I said at the beginning. America's social insurance programs are more important and more successful than they've ever been. These programs are also growing rapidly as a share of GDP. Before the recession hit, we were spending 8% of GDP on our three largest social insurance programs, Social Security, Medicare, and Medicaid. By the end of this decade, we're going to be spending 11.5% of GDP on these programs, so a full 3.5 percentage point increase. Let me make 3 points about this increase in spending on social insurance programs. The first point is it's not a surprise. For more than 35 years, it's been evident that the current decade was going to be a fiscally challenging one. We kept warning everyone when the baby boomers retired we were going to have fiscal issues, and guess what? They're finally retiring. So there's nothing surprising about the fact that we're facing fiscal stress right now or that spending on social insurance programs is going up. Indeed, if you go back and look at the trustees' reports, the actuaries' trustees' reports from the 1970s, you can see that they were predicting an increase in spending on these programs almost exactly like what has occurred. And for a while, our policymakers actually worked to prepare for the fiscal challenge we're facing in this decade. In 1983, OASDI revenues were deliberately set above the level necessary to pay benefits, with the explicit purpose of reaching our current point in history with a lower debt-to-GDP ratio than would have otherwise have occurred. Facing large deficits in the early 1990s, Congress and the President enacted a pay-as-you-go law to try to make sure we didn't dig ourselves into an even bigger fiscal ditch in advance of the retirement of the baby boomers. And then when surpluses emerged in the late 1990s, President Clinton declared a Save Social Security First policy in order to say that the surpluses should be dedicated to debt reduction so as to prepare the economy for the retirement of the baby boomers. And between 1993 and 2001, federal debt as a share of GDP fell from 49% to 33%. But unfortunately, the policy consensus around preparing us for the decade we're in right now fell apart in 2001, and we ended up hitting this moment in history not with very low levels of debt to GDP, but with historically high ones. The second point I want to make about the rise in spending on social insurance programs as a share of GDP is that this increase in spending on social insurance programs is a good thing, not a bad thing. Given that our population is aging, it is fully appropriate for spending on social insurance to be increasing during this decade. And as incomes rise, it is fully appropriate for a greater share of incomes to be devoted to health care, and therefore for Medicare and Medicaid spending to rise as a share of GDP. Though I would say that the GDP plus 2 growth rate that we've had over the last 20 to 30 years is almost certainly excessive, and that's why the cost containment features of the Affordable Care Act are so important. The third point I want to make is a somewhat obvious one. We need to pay for the increase in spending that is occurring. And we need not only a plan to pay for the increase in spending that's occurring in this decade, but to pay for the further increase in spending on social insurance programs that almost certainly will occur as the expenditure share of health care continues to grow in our economy. I have some specific recommendations to make in this regard. But before I make them, I want to explain 2 experiences that lead me to make the recommendations that I'm going to make. The first experience was rereading the Social Security reform proposal that Senator Daniel Patrick Moynihan made in March of 1998. And I was pleased to see, as I was walking in today, David Podoff, who had a big role, I think, in creating that proposal. In that plan, Senator Moynihan proposed cutting the payroll tax immediately so that Social Security would stop running surpluses, and then raising the payroll tax gradually over time to maintain pay-as-you-go balance. The proposal was immediately criticized by many Social Security experts. Brookings Review actually put out a special edition with 4 different critiques of the plan to cut the payroll tax, to cut payroll taxes. And at the time, I certainly thought it was a pretty strange thing to take revenue away from Social Security at a time that it was running out of revenues. But what the senator saw that others missed was 2 things. He saw that there was a significant risk that the Social Security surpluses, money that was being raised through the regressive payroll tax, would not be used to pay down debt, and it would instead be diverted to other purposes. And he was right. The Social Security surpluses ended up enabling and financing the 2001 and 2003 tax cuts. And Senator Moynihan also foresaw that the trust fund arrangement would lead to fiscal pressures when the baby boomers finally retired, because when it became time to redeem the trust fund bonds, that we would have to come up with that funds from somewhere, and that that pressure, the fact that it was going to be hard to do so, would both create pressures to cut back on our social insurance programs, but also threaten our ability to finance core government operations, especially the government investments in infrastructure and education and research that are critical to our long-term economic growth. So looking back, I now think that it is clear that the trust fund structure we established in the 1983 Social Security reforms was a serious policy error, and one that is responsible for a significant portion of the mess we find ourselves in today. And I think the lesson we should draw from this experience is that our large social insurance programs, Social Security and Medicare and Medicaid, should be funded by dedicated revenue streams that match expenditures on a year-to-year basis. Though I would allow some smoothing and delays in matching revenues when we are in economic downturns, so that the revenue feature doesn't counter the stimulus benefits of the increased spending that occurred during downturns. Doing so, having our revenues always matching our spending, will assure that the programs themselves have adequate financing, while also guaranteeing that other core government operations, particularly those important investments in our future, are not threatened by budget shortfalls in our social insurance programs. When Senator Moynihan put out his reform proposal in 1998, he did so in a speech at the Kennedy School of Government at Harvard. And after that speech, there was a little reception for Harvard faculty members with the senator. And when the senator walked into the reception, he immediately bumped into Martin Feldstein. And the senator said, Marty, how did I do? And Professor Feldstein said, A-. And the senator started prancing around the room saying, Marty gave me an A-. Marty gave me an A-, until he bumped into our dean at the time, Joe Nye. And Joe said, Senator, A- is the average grade at the Kennedy School. Now, I'm not sure what Harvard's policy is on posthumous regrades, but I think I would propose today that the senator deserved an A+ for that speech, not an A-. So I said that there were two experiences that informed my views on how we should finance our social insurance programs. And the first was rereading the Moynihan proposal, and that led me to think that we need dedicated revenue and revenue that matches our expenditure on a year-to-year basis. The second experience was co-authoring a report recently on the fiscal imbalances in Europe, the US, and Japan with some experts on the political economy of budget policy in Europe. And what I came to realize is that compared with the European democracies, we are at a significant disadvantage in dealing with our fiscal imbalances. In European countries where the governing party has a strong parliamentary majority, the governing policy can simply implement whatever changes are needed to restore fiscal sustainability. And in European countries where there's a coalition government, those governments typically enter into coalition agreements over policies at the beginning of the government, and those agreements are enforced because if the government reneges on those agreements, part of the coalition will leave the government, and the government will fall, and there will be new elections. So there's an enforcement mechanism to make agreements actually happen. In contrast, in our system, which is based around separations of powers and checks and balances, inertia reigns. It's very hard to create a true action-forcing event, as the recent experience of the debt limit agreement and the Congressional Supercommittee provides clear evidence of. Now, to be fair, our system seems to do somewhat better than this comparative political economy story would suggest. After all, we did pass major deficit-reducing legislation in 1983, 1990, 1993, and 1997. And even in the midst of the worst economic downturn in our lifetimes, Congress and the President enacted legislation to address health care costs, the largest component of our long-term fiscal imbalance. Moreover, our political system doesn't have to be perfect in order for us to balance our fiscal situation. To stabilize our debt to GDP level, we need policy adjustments of about 3% of GDP. What this means is that Congress and the President, they can bat 333. They can fail 2 out of every 3 years with lots of consternation and more heat than light. And every third year, all they have to do is basically solve a third of the problem, do about 1% of GDP worth of adjustment. And over a decade, we'll be fine. So, I think we can probably bat 1 for 3, or bat 1 for 3, and even in those years, just hit a single. And in fact, that's what we did in the 1990s. It took a little bit of progress in 1990, and a little in 1993, and a little in 1997. And that's how we took care of our fiscal situation. That said, given our political system's tendency toward inertia, I think it doesn't really make sense to let the spending side of our social insurance programs operate on autopilot without a mechanism to make sure that there is sufficient revenue to pay for the programs. Now, some have argued that we should require that social insurance programs be appropriated annually and compete with all the other spending for available budgetary resources. I think that would be a terrible idea. The ability of our social insurance programs to respond directly to economic conditions is an important feature of those programs. Moreover, potential beneficiaries should be able to make long-term plans knowing what their retirement and health benefits will be. And as we've seen, when mandatory-like programs are treated as discretionary, for example, with VA Health or Pell Grants, it wreaks havoc in the annual appropriations process, a process that has enough difficulties as it is. So I think it's fully appropriate for social insurance programs to be mandatory spending. But what we need is an automatic mechanism to ensure that our revenues keep up with spending. And there are lots of different ways we could do this. One could fund the large social insurance programs with dedicated revenue from payroll taxes or a VAT, and the tax rates could be legislated to adjust automatically to keep spending and revenue in alignment. Again, it would be important to have the taxes adjust with a lag to avoid raising taxes during economic downturns. For Social Security, we could maintain a balance between revenues and spending by having both the benefit levels and the revenue levels indexed to longevity and other demographic factors in such a way that the adjustments happened equally on the revenue and the spending side. For Medicare and Medicaid, we could establish a dedicated revenue source and restrict the growth rate of payments in those programs to something like, or of payments per patient in those programs to something like the growth rate of GDP, unless Congress explicitly votes to raise the dedicated tax rates. So there are lots of different mechanisms that one could use to make sure that revenues keep up with spending. And the important thing, I don't think, is the particular mechanism. It's really that the key is that our social insurance programs should be funded on a pay-as-you-go basis and with dedicated revenues, and there needs to be some automatic mechanism to make sure that balance is maintained between the revenues and the spending. If we do so, it'll stabilize our fiscal situation, it'll protect our social insurance programs, it'll ensure that we can afford to fund the other functions of government, and especially those that represent investments in the future of our economy. So thank you very much for listening to me, and I think we have a few minutes for questions.
Thank you, Jeff. And we do have a few minutes for questions, and I'd like to invite those of you with questions to come to one of the two standing microphones, one over there, one over here. Pardon me? And there's also is also a mic moving around the room if you just want to raise your hand. Since these sessions are being recorded, please identify yourself and your organization, and please try to keep your question brief so that we can fit as many questions and, moreover, answers as possible. We'll start with a question right over here.
David Potoff, University of North Carolina, Chapel Hill, and Georgetown University. Hi, Sheila. On behalf of the Moynihan family, I'd like to thank Jeff for giving Senator Moynihan, I remember that story, increasing his grade. Sheila was, I should also acknowledge the fact that Sheila was instrumental in making that lecture happen at the Harvard Kennedy School. I also like to thank Jeff for dancing around something that was tied into the pay-as-you-go system that Senator Moynihan advocated, namely something called personal retirement accounts, which got mischaracterized, and I really don't want to get into that. But I think there's one other lesson to learn from Senator Moynihan, which you actually alluded to, and that's something we don't do in politics, and I don't know, maybe we could go, maybe we don't, it's because we don't have people like Senator Moynihan around anymore, is that people can change their minds. Indeed, Senator Moynihan was on the Greenspan Commission, which put in place a large buildup in the Social Security trust funds. But when he realized that it just wasn't working the way it was supposed to, he flip-flopped. He changed his mind. And I think that's a very important thing to note. And he said, you know, the system that we put in place in the Greenspan wasn't working, and we need to return to pay-as-you-go. I wish we just had people like that. And I don't know how we get there, but I think it's important to note that there are two different ways of funding Social Security. And I think what you have put forward in terms of making sure we have dedicated revenues matching the dedicated expenditures is a very good way to go. And again, thank you very much for your kind remarks. My question is, do you think we're going to... Okay, I guess I'm supposed to have a question. Question is, you know, how do we get to a place where if things change, we can change things? Do you see any movement in any of those every 3-year bills of doing that?
I guess. Well, thank you for those comments, first of all. But I think my model of policy reform is basically you can't predict when the opportunity is going to come to do something sensible. And so what you have to do is do the hard work. And once every decade, once every 20 years, if the window opens and you've done the research and you've done the thinking and you've done the coalition building, when that window opens, you have to seize it. And you know, I think we've seen, for example, with health reform, you know, every 15 years or so there was an attempt, and lots of them failed. But then we finally got another opportunity, and we got it done. And I think that's really the right model for those of all of us who care deeply about social insurance programs. We should be working on having the solutions ready. We can't really predict when they're going to be needed, but you know, and I see people like Steve Goss who've probably been working, making sure everyone was ready for 30 years for Social Security reform, waiting for that moment. But sooner or later it's going to come, and so if we do the hard work when that moment comes, we'll get the right policy.
So for our next question, we will turn to Steve Goss, who may actually be thinking about 75 years.
But Jeff is right. Since '83, it's been a little less than 30 years, so we're probably primed and ready for the next round. Jeff, just a question. Your point is extremely well taken, and I remember Bob Myers for many years was also arguing for why not have Social Security paid for on a purely pay-as-you-go basis where the dedicated revenues exactly match what is coming in. But we are where we are at the moment, and we do have this trust fund with credited $2.6 trillion. So given that we are where we are, what would you say and what would you do about the $2.6 trillion en route to getting to a pure pay-as-you-go plan?
No, that's a good question. And the answer to almost all questions about reforming Social Security is it's hard to talk about one component in isolation from the other. But I do think that given that we use the regressive payroll tax in this way, we absolutely should be keeping the commitment to pay benefits for the full amount of time that has been promised by the buildup of the trust fund. So, reneging on that commitment, given that we have already used the regressive payroll tax, promising people that we're going to use it to keep that commitment would be a big mistake. On the other hand, or not on the other hand, but at the same time, it's a reality that we have to pay for the benefits we're going to be paying out, and the fact that we have a trust fund there doesn't relieve us of the responsibility to have a fiscal policy that does more than simply add to the national debt. And so, I think what we need is some combination of, an absolute commitment to maintaining the promised benefits along with some new sources of revenue that make sure that we can meet that commitment while, not having debt become excessive.
Hi, Janice Gregory. This is kind of a historical footnote that has long puzzled me a little bit. And there is a conventional wisdom now that in 1983 we on purpose set out to build this gigantic trust fund. I was on the Ways and Means Committee in 1983, 24/7, 50 out of 52 weekends, and lived and breathed those numbers. And one of the things I did in the run-up to that was demand that we do sensitivity analysis on the trust fund. And the numbers I was looking at were really clear. If, depending on when we had the next recession, when you got into the end of the 80s, this was 1983, if you're looking at the end of the 80s and so forth, if we had a dip, we were going to be skating on ice. So this huge buildup that we had, and then only very slowly would we go up after that. So this huge buildup that we have, I think what you were talking about, you see your opportunities and you take them. It was something that happened, but not something that necessarily had to happen. And it's maybe some people were hoping for it. I was just hoping to get through. And so I think we do have to listen to what you're saying about being flexible, dealing with stuff as it comes, because we really can't predict the future.
That's a good point.
Yes. Yes, go ahead. You want to respond to that?
Steve wants.
If I just interject, Janice is exactly right, and as is another person Janice was only 3 years old at the time. I was a little bit older than that, way back in 1983. But just as a follow-up, at the time when we were doing estimates for both the commission and then later for Ways and Means, we were not quite as quick. We didn't have, the computers and the programs that we have now to be able to do annual projections of cost and trust fund ratios sort of overnight, which, Alice Wade and all the people in our office can do so quickly. And so we weren't able to as instantaneously provide the numbers going on a year-by-year basis. By the time the legislation was actually enacted, the present law, 9121 or whatever, we did have estimates showing the trust fund buildup, but it was sort of too late to go back and make the changes at that time. If we'd been in the position that we're in now, we might have had a different scenario over the long term. But Janice is exactly right. The commission at that time had wanted to look not just at the best case scenario for the near-term projections, because we'd been surprised by so much bad economic experience, but they actually asked to have devised economic scenario that was looked at, that was referred to as the worst case. Now, we all know there's no such thing as a worst case, but there was a really bad case economic scenario that was looked at to try to avert running into the wall again soon after the 83 amendments were passed. The longer term, though, because we were not able to turn around estimates quite as quickly back then as we can now, ended up with this rise up and then the drop down, which we all see in the 1983 trustees report. But the next time, we may have heard.
Oh, that's fascinating. I had no idea about the accidental feature of that.
Hello, I'm Eric Kingston with Syracuse University and with Social Security Works. First, Jeff, thank you for a very interesting talk. And I think it's interesting bringing up the Moynihan proposal in the context of the payroll tax cuts we're also going to be dealing with in the future. I'm wondering how you, a couple of questions here. How would you, in going back to more of a Moynihan type approach, how would you deal with the payroll tax holiday loss of revenues for the moment? How would you connect that to it? Second, how might it also connect to what I would view as a major crisis that we're facing, not Social Security, but in retirement income security for people in their early 50s? Is there revenue in there? How would you protect that group, which has been so hurt during this recession? And I guess the third point is just linguistic. I would reject the characterization of Social Security being a mess. It's really worked quite well. It continues to work quite well for the American public. I think linguistically it's important to talk about it both as a success, but I also think empirically it really isn't a mess. We're looking at a less than a 1% of GDP shortfall and gap if we look out 75 years. At the same time, we have a very large increase in population aging. So all of that, but thank you.
Those are great. On the third comment, I want to be clear. I did not, or maybe I wasn't clear enough in my speech, but I was not calling Social Security a mess. I think we face a big fiscal mess in this country, but I hope I was pretty clear that I think that all of our social insurance programs are as strong as they've ever been and are doing a great job. On the payroll tax holiday question, I think if we were in a system that wasn't focused on trust fund accounting and was simply focused on paying for benefits year to year, it really wouldn't have been an issue, because we wouldn't have been trying to say, how are you going to replace the revenue that's not coming in on some 75-year calculation? We would simply be saying we're paying these benefits this year, and we have this revenue stream. And so I think it's hard to predict the political economy about a system that doesn't exist, but I actually think that that small footnote on the debate over stimulus this year probably would have been less of an issue if we'd been under this scenario. And just to be clear, I think I was talking about long-term issues here. We absolutely need more fiscal stimulus right now, substantially more. The economic rule of thumb is that GDP has to grow 2% above trend for a year to bring the unemployment rate down by 1 percentage point. So if we want to bring the unemployment rate down from 8.5% where it is now to 6.5% over the next 2 years, we need GDP growing at 4.5% a year, which is 2% over trend for 2 full years. And I don't think anybody thinks our trajectory right now is 4.5%, and we should be enacting fiscal policies to achieve that 4.5%, because I think the minimum we should be doing is trying to bring the unemployment rate down over the next couple of years. I think in the interest of time, I'm not going to give you a good answer on the near retirees, but I'd be happy to talk to you more about that afterward.
Sheila.
Jeff, thank you. Terrific job. I have to just make a small side note that joining Moynihan at the time was Bob Dole. Just felt I needed to say that. But actually I want to turn to Medicare for just a moment, because one of your comments was a suggestion that a similar kind of strategy with respect to tracking revenues to expenditures is when you would propose for Medicare. One of the things we'll talk about in tomorrow's session, we'll hear a little bit about today, is this question of a premium structure for Medicare, and essentially a premium support structure that would in fact allow you to lock in a per capita expenditure for Medicare beneficiaries. It has supporters, it has some who feel quite strongly on the opposite side. And I wonder if you'd given some thought to how it is that you would imagine, because of the unpredictability of Medicare, because we are so challenged in terms of healthcare costs generally, and certainly with respect to per capita costs for Medicare, and with the aging of the population, we're living longer with more disabilities. I wonder how you would, in fact, think about that. Is it in the structure of a premium support system, or is it in some other method that might allow us to hold down Medicare expenditures?
That's a great question. So I guess the first thing I would say is I've been increasingly thinking that the lessons of behavioral economics are really important to thinking about the choices people make about their health care and their health insurance. And if you think about what we know from behavioral economics, the situations where people have trouble making decisions is decision-making over time, where you make a decision today and it has an implication in the future, decisions where there's a lot of uncertainty, and decisions when you're purchasing a complicated product. Now, all of those things describe the purchase of health insurance or healthcare more generally. And so I think these models that say, let's have an individual go out and look at 75 options and shop for themselves for health insurance, especially if that individual is 75 or 80 years old, is not the right model. That's the first thing I would say. On the other hand, I think it is the case that there needs to be a budget constraint placed on the medical system, and I don't think that can come through Medicare choosing what things are covered and which aren't. I think even though the technological challenge of figuring out what should be paid for and what shouldn't is hard, but the politics are impossible. So I do think that passing along a budget constraint to the providers is the right way to go, and I think the way to do that is going to be through accountable care organizations. That what's going to happen is that there are going to be global payments made on behalf of insured individuals and on behalf of Medicare or Medicaid recipients to groups of physicians and hospitals that provide care, and that those will have to grow at a certain rate. I guess I'm going to get in trouble given who's sitting next to me, and he's a good friend and a good person on this, but it's not clear to me we need insurance companies in the middle of this for Medicare recipients, that the Medicare can make that payment directly to an accountable care organization, and we don't need to have individuals who are 85-year-olds have to go shop across 9 complicated insurance products. They can just go choose their doctor in a health care group, something that they want to do and something they're probably pretty good at, and not have to get involved with insurance at all. And so I think there's a modified version that has some similarities to the premium support approach, but doesn't involve people having to seniors having to make choices of insurance plans. And so something in that spirit is where I think we need to go.
So I'm going to get myself in trouble with the timekeeper here and go for one more question, and I'm not even going to pick up, Jeff, on the debate about the role of insurance companies right now, maybe later. I will point out that as of last week, the 2 largest health insurers in Massachusetts, while Medicare is still paying 99% fee-for-service, have 70% of their HMO members in global payment accountable care sort of situations, and that's where the innovation is happening right now. Final question.
Hi, my name is Hillary Doe. I'm National Director of the Roosevelt Campus Network, which is actually supported in part by James' family, and was recently welcomed into the social insurance community here. I had a quick question about the proposal that you suggested. Certainly, in addition to ensuring that social insurance has dedicated revenues, some of us are also interested in increasing benefit adequacy and not just sort of maintaining the status quo. And I'm wondering which of the many, you said, possible formulas for ensuring these revenues best provides that opportunity to sort of provide adequate benefits for the most vulnerable among us.
Yeah, I guess my guess is that the issue is somewhat separable from the revenue issue. I mean, I think the more revenues are adequate, the less the more chance that we will deal with the adequacy issue. But I think there's a lot we can do, even in a revenue-neutral approach, to deal with adequacy, and particularly in the retirement program, thinking hard about whether we're treating married couples with different earnings profiles right, whether we're providing for single elderly individuals, widowers adequately. I think there's adjustments we could do that would make progress there, even in a revenue neutral way. Indeed, I started to write a paper, and I sort of right before I went to Washington, so I should probably finish it up this year, pointing out the fact that if you look at the poverty gap among the elderly, compared to the total amount of dollars we're spending on the elderly, it's a very small number. And it shouldn't take a very big tweak in our formulas to actually eliminate poverty among the elderly. And so I will probably get around to finally finishing that paper sometime this year. But I guess I don't think. I mean, I think in general, the better revenues are provided for, the more chances we'll meet the adequacy challenge. But I think that shouldn't. I think those are sort of 2 separable things. We should also be figuring out how to make sure the most vulnerable are well protected, given a fixed amount of resources.
So, 2 quick observations. First of all, there was a reference made earlier to the fact that we don't have many people like Daniel Patrick Moynihan around anymore. I don't think there's anybody like Daniel Patrick Moynihan. But I really want to thank Jeff for many stimulating ideas this morning, and in particular for directing us to really challenging the definition of what it means to be funded in social insurance. I think that those who are pure market economics advocates tend to take the principle of funding private employer-sponsored pension funds and even state and municipal pension funds and try to apply that to social insurance. And the concept of funding by a dedicated income stream, while there are many aspects of that we can debate in terms of what happens in future legislation and so on, is a very important part of this discussion. So thank you for a very stimulating opening speech, Jeff.